Ironically, one of the risks here is not the concentration of performance in these tech stocks, but the concentration of earnings. It is very unusual. So, the Eurozone's actually potentially longer term quite well placed for both that more stuff-heavy world. People are going to have to spend money on stuff, not on just IP and tech.
Absolute Strategy Research is one of a handful of highly regarded, independent global macro research firms that provides valuable insights to institutional investors and other big corporations. Last year, we heard from co-founder and chief investment strategist Ian Harnett, who shared his views on markets, and I'm delighted that we have the team from ASR back on the podcast. Given the current economic, market, and political outlook, there's a lot to cover. So we've decided to split this interview into 2 episodes. In today's episode, Ian and I will discuss broader macro views, if anything can break today's market concentration and narrowness of returns, and the key opportunities and risks. The second episode will be released in September, and it will cover the upcoming US election. Given recent news flow and the importance of this election, it certainly warrants its own episode. I hope you enjoy these discussions. It's a pleasure to have you back on the podcast, Ian.
Well, thank you very much for inviting me, Alison. Always a pleasure to work with the team at Antipodes.
To get us started, you were recently in the US meeting clients and policymakers. What were your key observations and conclusions from that trip?
I think the key observations came from the discussions that I had with people at the Atlanta Fed Financial Markets Conference that I was very kindly invited to attend. And I think there, the key observation was that a number of the Fed chairs that were represented there were talking about the fact that the economy was more robust, that although inflation was coming down, they wanted to see more of a decline in that inflation, and also that the terminal rate was going to be higher than they previously thought. So, lots of discussion about that. The second element was a lot of discussion about the inadequacy of the discount window. All very technical stuff, but the bottom line is that they are preparing for the next crisis, and they recognize that the tools they have at the moment is not quite ready for that. And the final observation was that a lot of the local regional Fed governors are using local survey work. They want to know what their own constituents are represented and how they feel about the economy. So, in this world post-pandemic, where we've seen a shift in some of the economic data and perhaps some of that reliability of data, they've moved to their own surveys. So watching some of those local regional Fed surveys, I think, has become a much more important element. Overall, from the clients, it was, crisis. What's crisis? There's very content to continue buying these markets, and of course, the events of the last few days coming out of Japan, has perhaps thrown some of that complacency into disarray. But I'm sure we'll deal with that in a moment.
And Ian, just to clarify some of those terms you did mention. So the terminal rate higher, so that long-term interest rate being higher than where it has been in the past, and just in a sentence or two, the inadequacy of the discount window.
So the problem is that there's a lender of last resort that is required here, and what they found with the crisis of the regional banks was that actually the regional banks didn't know who the person to phone at the Fed was. Some of them didn't have collateral at the Fed. There are 5,000 banks in the US, which was a figure that shocked me. Only 3,000 have facilities with the Fed, and they're all supposed to. So, there's a big recognition that, the banks didn't want to go to the Fed to ask for support. But actually, if they'd have gone earlier, it might have meant that there was less of a problem. So it's reducing this stigma of going to the Fed for support, but also making sure that everybody's got processes in place to actually do it. So, I think there's much more work that will be done on trying to make sure that banks and potentially non-banks have greater access to Fed liquidity when they need it, without it being seen as a signal that that bank is about to fold.
Let's spend a bit more time on that US macro. Now, US exceptionalism has persisted beyond what most market commentators predicted. Now, you made mention of it just briefly before. Some of the recent economic data, very recent economic data, has been relatively weak. So it'd be great to get your take on what you're seeing. Do you think cyclical risks are building, or is this a blip? What's your view?
Well, one of the great inequalities of life is that the US does well when things are going well for them, and when they export crisis to the rest of the world, they tend to outperform as people go back to safe haven assets, and that safe haven asset is very much the US Treasury market. So we've done quite a bit of work on this recently. We're still overweight the US because to get the rest of the world outperforming, and this is something for your clients to think about, you need three things to have occurred. First of all, the rest of the world tends to do well when global economic growth is rising and accelerating. Now, as you mentioned, Alison, we're seeing some of these numbers starting to weaken. A weakening global economy tends to favour the US relative to the rest of the world, sadly. So until we get China re-accelerating, until we get the Eurozone re-accelerating more aggressively, hard to see that US exceptionalism coming under pressure. The second element is that you need ironically, you do need the dollar to be going down for the rest of the world to outperform. And that requires the third element, either real interest rates going against the dollar or the real economic activity going against the dollar. So that pickup in global growth has to come from outside the US. And at the moment, we're seeing places like the ECB cutting ahead of the Fed, the Bank of England cutting before the Fed. Real interest rates potentially are going the wrong way for that. So we think it's still an environment where you want to stay long the US, even if markets come under a bit of pressure.
And your read on some of the data normalising. The consumer is normalising in the US. We're seeing the employment data normalise. Are you seeing anything in the data to make you take pause?
No, I think, we've had the view that interest rates will come down probably in the second half of the year in the US. I think we've been concerned that some of that service sector inflation was going to remain stickier in the US, and that would mean that the Fed would, probably want to see more evidence that things were slowing before they started to cut rates. So I think Dominic White, our chief economist, is still very skeptical about all this suggestion that there'll be a short-term interest rate cut, coming any time in the next, week or two between meetings. So, September would still be the earliest that we would see that.
Sure. So, and that is certainly that rhetoric that came out of the recent comments from, with Jerome Powell, guiding the market, so to speak. Certainly growing evidence that the policy cycle has peaked, that the 25 basis point rate cut very much on the cards in September. How do you see this loosening cycle playing out in the US?
So I think we would see it as a modest loosening. Because economic growth remains relatively healthy, there is a small risk that things might decelerate more rapidly. But at the current time, we're looking at the healthy balance sheets of the household sector, and we're looking at continued fiscal support, that you have got, and potentially will have that post-election as well, that is helping to keep employment growth very strong in the US, or relatively healthy in the US, And that government spending is offsetting some of the pressure that you might be seeing on the private sector from those higher rates.
Do you think the market? Do you think that soft landing, those dovish rate cuts, is well and truly priced into markets? And perhaps the market might be underpricing the higher for longer scenario, and certainly the risk that a higher for longer potentially transitions into a hard landing.
Yes, I think a lot of the good news is very definitely priced into valuations. But what we've seen in markets is that valuations have become less important in many ways. As long as the earnings growth is there, Nick Nelson, who is our head of equity strategy, is just highlighting those earnings numbers, will be absolutely critical. If you do want a black swan, then the rise in real interest rates that we've seen over the last 2 years, would historically have fitted very nicely with recession probabilities going up. So I don't think you can discount the possibility of a harder landing. And as you say, a lot of the good news is already in the price. But for now, if you're looking at markets and the Fed cuts rates because inflation is coming down, historically, the two times that we've seen that in the last 50 years, 1995 and 1998, those saw the equity market gain another 20 to 30% in the next 12 months, regardless of where you were starting from in terms of valuations. But if they are forced to cut rates because economic growth is slowing or you've got some kind of major financial crisis, historically equities have underperformed bonds by 24%. And it's basically been 12-2 in terms of bad news versus good news. But at the moment, we're looking at a world where earnings expectations are going up and the Fed is thinking of cutting rates because inflation is coming down. That's actually that's a pretty positive environment for risk assets. So at the moment, we're still sticking with that more positive stance.
And do you think, though, with that stickiness in inflation, that could potentially create a little bit of a tension in that Fed internal debate? What do we do next? Because you have got certainly the employment data at the margin looking a little bit weaker. I guess, does that make it a bit harder?
And I think that ambivalence, of what the economic data is saying between growth and inflation is critical both to policymakers, which means that they'll probably delay rather than accelerate rate cuts, but also for equity investors as well, because one of the things that we've found is that the trade-off between growth and inflation is really important for valuations. And in a world where inflation's coming down, that's great. But if growth expectations are coming down faster, then you don't get the full boost to your valuation. So this is why we're saying earnings become much more important.
And I suspect, Ian, as well, that earnings growth needs to be broad, doesn't it?
Yes.
It has arguably been disproportionately concentrated in a handful of stocks, that earnings growth. So it is critical that we see that earnings growth come much more broadly in order to provide that support.
Yes. And that is one of the things that we've seen. So Nick and Charles Carr, our head of quant strategy here at ASR, have highlighted that the beats that we've seen have been all about margin growth this quarter. And so that is important, and it has broadened out. One of the points we've been making to clients is that, ironically, one of the risks here is that not the concentration of performance in these tech stocks, but the concentration of earnings. It is very unusual for any sector in the last 50 years you've only seen, I think, three other sectors that have had more than 20% of total market earnings in the US. The energy sector, and the pharma sector, and consumer discretionary. And each time they've not managed to sustain that, because what you find is that the rest of the market runs out of cash to be able to buy their products. And so, if you build in that expectation of those earnings growth and that type of earnings share in perpetuity, you're likely to be disappointed. And so I think this is why we're starting to see some of these tech stocks underperform. The point we've made is that, the capex forecasts for the rest of the markets are inconsistent with the sales growth forecasts for those tech stocks. So, this is where, the market starts to untangle some of the inconsistencies, and, you get a limit on how far some of these stocks can go. But, as I say, if the Fed's going to cut rates, not because there's a crisis, but because inflation's coming down, it's still, difficult to get too bearish too soon.
You made a point earlier about needing, if we want to see the rest of the world outperforming, we need to see the Eurozone accelerating. We need to see China, growth coming out of China. The rest of the world, if we put China to the side for the moment, but the rest of the world is more advanced in their rate cutting cycle. We've seen the ECB, the European Central Bank, already cut rates. Bank of England has followed. And there are other central banks that have started cutting rates. What does that mean for growth in the rest of the world?
Let's go back to the phrase long and variable lags, Alison.
Yes.
So, eventually that will turn things around. But, I think the danger is anticipating that too soon. As we've seen perhaps with Eurozone equities, people getting very excited. We keep on seeing these spurts where Eurozone equities manage to outperform for a week and a half, a quarter or so, and then they give it all back. And so I think, you wanted to park China, but I'm afraid that, one of our black swan charts, another one of our black swan charts for people, is that historically over the last 20 odd years, what happens to Chinese economic growth has been really critical to global equities. And I think one of the mistakes people might be making now, because it's become more difficult, either from an ESG perspective or from a geopolitical perspective, to invest in China, particularly for US investors, and that was one of the other themes that came out when we were there recently, is that they ignore it. And they think it's that as we've moved to this more fractured global economy, we will actually then see China being less important. We may find that actually isn't the case, that its share of GDP in the global economy is still important, and the weakness that we still fear is out there. The Chinese authorities have not done enough yet to turn their housing market, consumer confidence, consumer sentiment around. Adam Wolf, our head of Chinese economic analysis, recently presented on this to Congress about his concerns. Was invited to do that to their special report. So we don't see that as it's going to take some time, I think. So I think 2025 is when we would start to see some of that global outperformance relative to the US coming through. So the danger is people trying to get too optimistic too soon, just because valuations look cheap in the rest of the world relative to the US.
Can you see a situation where Europe is more sensitive to the loosening cycle? Just as it was on the way up, it can be on the way down. And so that loosening cycle, which is already sort of kicking into gear, can stimulate growth perhaps a little bit better than what you might expect.
So I think the thing that will actually do that, rather than it being interest rates, is perhaps that weaker euro against the US dollar. So competitiveness becomes the critical factor here. The problem that I have with this story, and having looked and monitored Europe for the last 30, 40 years, is that it is driven by Germany. Germany is at the heart of the Eurozone story. And what we've seen recently is that the periphery has been outperforming Germany because Germany has, has that exposure to the weakness in the Chinese economy. So again, I'm afraid that I come back to, wanting to, I want to be greedy. I want, all of these things to come together really to get more excited about the Eurozone story. We're still very cautious about the UK. It's had a very good run. Clearly we've got a new government in the UK, which provides some hope of change. But again, my concern there is that our competitiveness is not very strong, and that we've got deficit problems here as well. And for emerging markets, I come back to the simple chart that we've used over and over again, and I'm sure you and your clients have seen this a million times. You need a weaker dollar for the emerging markets to really outperform the emerging markets outside China. So those are still some of the preconditions that we're looking for. The reality is that previous periods where the rest of the world has outperformed have really come because US earnings have cracked. And so until you start to see that much bigger crack in the US earnings outlook, which really then drives interest rates down, drives the dollar down in the US, that's the key to getting the rest of the world outperforming. And the one final point I'd make, Alison, is that although the relative valuations are cheap, in terms of absolute valuations, they're not at the kind of lows that we saw in the GFC, in the pandemic. They're in, quite a lot of markets are still in their mid ranges for, they're just not at the peak that, the US is, and in the long run, valuations do matter. So on a 10-year view, I have no doubt that, the non-US bits will probably outperform the US bits. But do we want to make that call today? Not yet.
So it does, in terms of Europe's strength, and as you mentioned, Germany being critical, it's the link to China, is your point. And even with those valuations, European valuations being, low teens, let's call it, at an index level, still a bit of a wait and see. And I think we would agree with you that point that China has policymakers in China have moved slower than what we anticipated, and I think what many people anticipated. It is interesting though, Ian, I guess at an index level at 9 times earnings. What do you think the market is pricing into China? 9 times earnings is low.
Yeah, and I think that it's pricing in an investability discount. So it's not just that economic growth we think is converging back down towards 4.5%, and that's a more sustainable long run level. But actually, just whether you can get your money in and out without political interference, be that either from the Chinese authorities or more likely from the US authorities or any nation that wants to be aligned with the US, because anti-China rhetoric and potentially policy is one of the few bipartisan narratives coming out of the election environment. So I think that question about overall investability is the critical thing. Just going back to the Eurozone for 1 second, one of the one thing that I think we feel comfortable focusing on is that as we go into the second half of this decade, we're going to move away from what we would call capital light business models, which the US has excelled at, into capital heavy business models, around the infrastructure build out for climate transition, around infrastructure for transportation, non-climate related transportation, and around the build out of defence spending, and there, we see Eurozone, having underinvested in defence, and relied on the US in the past. We're already seeing a shift, very strong shift, towards much more industrial spending. So, the Eurozone's actually potentially longer term quite well placed for both that more stuff heavy world, as we would call it. People are going to have to spend money on stuff, not on just IP and tech, but also a world, where if China and the US separate, you need somewhere where you can do business. And so, the upside for Europe could actually be as the place where both China and America do business with, and manage to do business with each other via this, this third party. So the Eurozone has some potential longer term benefits. But the critical thing for this will be European credit union, credit and monetary union. We used to call it banking union, but now there's a recognition that it's the non-banks as well as the banks that will play a role. So, again, the defining changes will actually probably come much more when we see some of the institutional frameworks in the Eurozone sorted out. And Mario Draghi is producing a report around Eurozone productivity, and I'm sure that it's going to emphasise capital markets union as critical. Still, supposedly we're on a 5-year plan towards that happening. If they deliver it in 5 years, then that would actually be a big game changer for the Eurozone.
Yes. One of the topics I wanted to discuss with you, we're still at the very early stages of that policy-led energy transition. You talked about infrastructure build out, not just related to climate, but beyond that as well, the onshoring investment cycle. So clearly that capex cycle is something you're thinking about very closely at ASR. Is this priced into equities?
No, and I think that's still structurally, one of the key areas that we would be looking at. There's been this shift away from industrial goods and industrial sectors towards technology over the last 5 years. We see there being structural benefits to investing in those kind of areas. And so rather than just buying low PE or low valuation sectors, it's less of a value story per se, and it is more of a policy-led, economic-led, societally-led narrative. But what that will also mean, however, and this is perhaps how you square the circle on some of the mean reversion that you've talked about, Alison, is that those things are going to be more expensive. And so although in the short run you can see China exporting deflation in goods prices, offsetting some of this sticky service sector inflation, going forward, if we are going to have, energy transition, if we are going to have increased spending on defence, if we are going to have better infrastructure or rebuilt infrastructure, society will end up seeing costs rise. And if you want to see that, energy security, food security, and that geopolitical reshoring, then again, these all point to, less portable global capital, less portable global, services and goods, and higher costs in higher cost economies such as Australia, the UK, the US, developed economies more generally.
Mm. So, that capex cycle ultimately is inflationary.
Yeah, and that tends to take you back towards value trades rather than growth. And that's really the narrative that you'd get. Look further out, that is.
Returning to the concentration of market performance, that narrowness of returns around those few mega cap tech stocks, is this investment cycle that we've just spoken about, Can this break this very extreme market concentration that we've been seeing?
Yeah, it'll be interesting to see what breaks that that investment cycle, whether it will collapse under the weight of its own expectations. And we have had one of the things that we look at is long run earnings expectations, not because we actually believe the numbers, but they're a really good indicator as to people's risk preference. And those long run earnings expectations for the US tech sector have been running at 17% plus compound. And historically you just haven't been able to deliver those kind of numbers. No. So that's one of the kind of things that we would be watching out for, as to just how quickly those type of earnings can collapse.
It is interesting, isn't it, when you've got hundreds of billions, these are very, very large numbers, being ploughed into the AI arms race. And we at Antipodes, we often discuss that, absolutely AI will change our lives in ways that, we don't know. We can't even predict today how it will change our lives. But today still, in the backdrop of this enormous amount of investment, there's still no clear use cases on how AI will be monetized. And, I think the market is, or investors are starting to ask those questions. What is the return on this investment? And you sort of touch on it will collapse. This sector could, or these handful of stocks could collapse under the weight of their own expectations. I mean, is that how are you viewing it?
Yes, and we're very definitely having done this for far too many years now. Looking back at the way that we saw the tech bubble collapse in the early 2000s, it's not that the long run structural story
doesn't exist
failed. We are living in a digital world.
Absolutely.
The World Wide Web has transformed our lives. Everything we were promised in the early 2000s has occurred. But Microsoft, Apple, they all fell more than 50%. And Amazon, even though they ended, and it took between 5 and 15 years for them to regain the price levels that they hit in the peak in 2000. There's a price for everything. And, I think that, we would see current valuations as unsustainable and earnings growth that a lot of people are thinking will just drag those earnings, those valuations down, probably unlikely to be realized at some stage. But, timing that's very dangerous, very tricky. But recognizing that you're going to need to have a spread of these AI related stocks, but that there's probably a better valuation to buy them at, in 3 years' time or 2 years' time, or maybe even 6 months' time. For us, the thing that probably will unwind it is actually the funding, because non-bank. One of the things we've emphasised is that a lot of this funding has not come from the banks, but from the non-banks. And if we see liquidity start to dry up, non-bank liquidity dry up, and private equity funds and private credit funds are already starting to see, a bit of signs of cash burn coming through in some of their stocks, those are the kind of things that could unwind this. And that access to credit that non-banks have provided for both households and corporate, particularly in the US, we think has been critically important. And if that starts to change, then you could start to see, as you say, people questioning the use case for this AI expansion changing very much more dramatically.
So that liquidity being an additional weight on those handful of stocks.
Yeah.
Although, Ian, I want you to circle one thing for me. You're overweight to the US, your view. And I actually do want to ask more broadly about your overweights and underweights. But before we do get to that, overweight to the US. But when that US index is so being dragged up, or the value, dragged up by those handful of stocks, and we've just discussed some of the risks there. Explain to me your overweight then.
It's very much an asset allocation level. It comes back to this idea. it's slightly sneaky that because all our indices are measures in dollars. So until the dollar comes down, it's really hard to get bearish on the US equity market relative to the rest of the world. You need that dollar weakness as being the critical factor. So, at one level, forget about the stocks, forget about the specifics, forget about the valuations. It is about, the US dollar still being the dominant factor. Now, if we were to see the things change, perhaps in a Trumpian world, where the Trump administration is rumored to be focused on getting lower dollar, a weaker dollar, then that would be a very different narrative for us. But for now, we can't see that happening.
So in an overweight US in an asset allocation sense. So if you can, Ian, bring your economic and market views, together. Can you take me through your key underweights and overweights, both from not just from a country, but also from a sector allocation, and perhaps give us a bit of colour on your positions?
Okay. So, the things that we would focus on, is that we still think that economic growth is going to be relatively lackluster. But not disastrous. So we're not talking about recession, but we are talking about inflation moderating, but again, not coming down dramatically. Staying at reasonable levels. With the US holding interest rates higher for longer relative to the rest of the world, that still keeps us overweight the US dollar. That overweight the US dollar is also more consistent with a world where economic growth is slowing rather than accelerating. So that is at the heart of why we don't feel that we can take the US equity market down relative to the rest of the world. What we do see, however, is that areas outside China are actually benefiting from some of the transfer of goods production out of China into those areas. So we have a reasonable exposure to those non-Chinese, non-Japanese Asian markets. And at one level, given where Australia has started from, we've become a bit more positive on Australia in recent months. As Australia has, it would be one place where perhaps the valuations, can play out a bit better. But we're neutral on Eurozone. We're not negative on it. And again, we've upgraded Eurozone rather than downgrading it. And, we are cautious now on Japan. So the good news is that Nick made that move out of Japan back in May. And that's now paying off quite nicely, in our view. The place where I'm still very nervous about is the UK, where, as I say, it's got a few problems, and not least of which is that unit wage costs, its competitiveness is not good. So a stronger currency is actually bad news, I think, for UK equities. In terms of the sectoral plays, one of the things that we've been doing in recent months has actually been moving to a bit more cyclicality in our portfolio. As I say, we're overweight structurally on some of those industrials, but Nick Nelson had been moving our banks exposure more positive as well, to reflect the greater willingness to increase loan growth, not just net interest margins. And we still prefer tech software to tech hardware in this environment. But our major underweights are still areas like construction and materials and chemicals. And we're still reasonably nervous on some of the basic resource sectors.
So just to bring all that together, so still overweight the US, neutral on Eurozone, but at the margin you've become more positive than from where you were.
And effectively, we've overweighted Eurozone relative to Japan. So that's the other way of thinking about it.
Yes, so overweighted Eurozone relative to Japan, seeing some opportunities in, let's call it Asia ex-China, that are benefiting from that transfer of goods production. Yeah. Yes. And then in terms of sectors, being more constructive around cyclicality, overweight industrials, linking that back to new drivers in capex cycles, and overweighting banks around a willingness to increase loan growth. And we're particularly seeing that coming out of Europe, aren't we, Ian?
No, so that's a very good summary, I think.
Now, Ian, I know I've kept you chatting for quite some time, and I've got one last question. I really want to discuss I want to put to you the alternative scenario. Now, is it possible against a backdrop of stronger public and private investment around, tech, energy transition, infrastructure, what we've already been talking about, along with a weaker fiscal position, aging population, Trump risk, for example, unfunded tax cuts, that policy may actually be appropriately set or even potentially too low. And in this scenario, what level of rates would be restrictive enough to induce a recession?
So, I think my take would be that policy is broadly adequate in the US. I think that, the one place that I feel nervous about the policy setting is the UK. Because, if you really want to get inflation back under control, the lesson from the 1980s and 1990s is that you have to have interest rates above unit wage costs. And, so what I would be saying is look for countries where interest rates are below unit wage costs. Those are countries where policy is potentially being eased too rapidly. So I'm afraid if I was on the MPC today, I would be one of the hawks, because I think that we won't get inflation under control in the UK if we don't if we're not willing to have a recession. And I do think this is a general problem, that policymakers seem to have lost the willingness to recognize that actually creating excess capacity, and freeing up capital, and avoiding having zombie companies and zombie economies, that is actually not helpful in the long run. So, I think the danger is that the longer that we avoid recession, and by keeping policy perhaps a bit too loose, rather than being prepared to flirt or skirt or actually encourage recession, to get inflation back under control, the greater the systemic risks you build up on the financial side. But that's probably that's a discussion for another 45 minutes.
Yeah. So in terms of the data points, in the context of keeping your eye on the alternative scenario, the data points that we should be tracking, you've called out looking at interest, looking at where interest rates are relative to where unit wage costs are. Yeah. Are there any other key data points we should be tracking? Or is that that's the one?
For me, that's the critical one that, back in the 1980s when I was in central banking, was the kind of thing we were looking at the time, and I think is still relevant. I think the other element is, you talked about the fact that fiscal support. In the US, the bulk of the employment growth in the last 18 months has come from government or quasi-government related employment growth. So ironically, if President Trump was to be re-elected, and he cut back government spending and government size, that actually could trigger a bit of a slowdown. So, for David Bowers, my co-founder at ASR, and myself, it always comes back for equities versus bonds is just basically, the output gap so whether the economy is growing above trend or below trend, and the unemployment rate. And so, those are the things that we're watching. If unemployment goes up, equities tend to struggle relative to bonds. And until policy is tight enough to push unemployment up, then it probably tells you that policy is either neutral or loose. So we're still of the view that policy is fairly balanced at the current time, but it's certainly not overly restrictive.
No, but you see the loosening playing out perhaps slower than maybe what the market would like.
And certainly what, the type of adjustments we've seen in the last week or so, where, you've now got 125 basis points, the cuts triggered, penciled in by, the end of this year kind of thing. It's, that seems to us to be far too optimistic.
Yeah. Ian, absolute pleasure having you back on the podcast. Thank you once again for sharing your insights, and you've certainly given us a lot to think about.
Super. Thanks very much, Alison. It's always a pleasure to be working with you and the Antipodes too. Thanks for the great questions.
For further information on Antipodes, head to our website antipodes.com, and you can also follow us on LinkedIn and Twitter.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.